In 1950, a 20-year-old kid walked onto the Columbia University campus. He had exactly $9,800 to his name, every penny of it saved from delivering newspapers, from mowing lawns, and selling chewing gum door to door. Today, that same person is worth $147 billion. His name is Warren Buffett. While most people attribute his success to a genius for picking stocks, the foundation is actually built on intense frugality. Even as his income exploded into the billions, his personal spending barely moved. He still eats McDonald's for breakfast and lives in the exact same suburban house he bought in 1958. 99% of his wealth was accumulated after his 52nd birthday. His fortune is the result of extreme, replicable discipline and decades of compound interest. Applying these disciplines requires immediate action. To execute this 5-step framework before 2027 arrives, you have to start with step 1, a total audit of your financial reality. To find your net worth, take everything you own, savings and investments, and subtract every liability, like credit cards and loans. Then calculate your cash flow, income minus expenses. What survives is your savings rate. Below 10% is a financial emergency. You cannot make good decisions with bad information. For many people in their 20s and 30s, that net worth number is currently negative. Confronting that balance today is the mandatory starting line for building an unbreakable financial foundation. Step 2 focuses on financial defense. Buffett's core behavioral rule is to invert how most Americans handle their paychecks. Do not save what is left after spending. Spend what is left after saving. You pay yourself first and live on the rest. The silent wealth killer is lifestyle inflation, getting a raise and immediately upgrading your apartment or car. To counter this, you aggressively target the big 3 expenses: finding roommates, refinancing a car loan, or meal prepping to slash your grocery bill frees up the cash required to invest. That cash flow feeds step 3, building a financial fortress. Before any money hits the stock market, you need a 6-month cash emergency fund sitting in a high-yield savings account to prevent panic decisions. Here is the debt avalanche method in action. Your extra cash flow attacks the highest interest rate debt first. Once that balance is zero, you take that exact payment amount and avalanche it into the next highest debt. Mathematically, eliminating 21% credit card debt is a guaranteed return that beats any standard investment. Aggressively living below your means to build this fortress ensures that no single unexpected life crisis can ever force you into a decision that derails your financial trajectory. Step 4 contains the ultimate irony. The greatest individual stock picker in human history explicitly advises regular Americans and even his own family against picking individual stocks. His actual recommendation is to automate your investments into a low-cost S&P 500 index fund. By buying a fund like VOO or SPY, you passively own a fraction of the 500 largest, most profitable companies in America. This chart shows the historical growth of the S&P 500 broken into 20-year intervals. Over every single 20-year block in the history of the U.S. stock market, the index has never produced a negative return. You do not need thousands of dollars to get started. Modern brokerage platforms offer fractional shares, taking a single expensive asset and breaking it into accessible slices. You can buy into the American economy for as little as $5. Long-term wealth creation in the stock market is a test of behavioral patience. It requires buying consistently every month and refusing to sell during a panic, rather than trying to time the market or outsmart the professionals. Step 5 introduces active income generation. Buffett built multiple business streams, including a paper route, used golf ball sales, and pinball machine rentals, by the time he was 16. Relying completely on a standard salary places a mathematical ceiling on your wealth. Your income is capped by the hours you can work, and standard raises are frequently consumed by the pace of inflation. To break that ceiling, you can build modern income expansions. You might learn a high-value freelance skill like video editing, create digital products that sell repeatedly, or allocate capital into dividend-yielding investments that pay you quarterly cash. True financial independence requires shifting from trading your limited time for a capped paycheck to building diverse systems that generate cash flow while you sleep. Look at this chart simulating the next 20 years. If a 25-year-old starts with zero today and perfectly applies a 20% savings rate, eliminates debt, and feeds an index fund, The compound effect pushes their net worth past $1 million by age 45. The philosophical backbone of this strategy is what Buffett calls the inner scorecard. Real wealth provides the luxury of actual freedom over your time, rather than buying outward status symbols to impress others. The math is clear, but it requires momentum. Take out a piece of paper today, calculate your exact net worth, then open a brokerage account tomorrow and set up your first purchase. Warren Buffett used these 5 steps to build his fortune over 75 years. By starting this sequence today, you are putting the exact same mechanics of discipline and compounding to work for your own financial freedom. In 1950, 20-year-old Warren Buffett started his investing journey with exactly $9,800. This timeline charts his wealth accumulation over the decades. Notice how the line remains remarkably flat for years. The massive exponential growth, the billions of dollars, only spikes after his 52nd birthday. 99% of his net worth came much later. Despite a net worth of over $140 billion, his daily life remains highly grounded. He drives a simple car, eats McDonald's for breakfast, and continues to live in the same modest home he bought decades ago. He did not build this portfolio using Wall Street algorithms or exclusive insider information. He followed a strict mathematical sequence of 5 principles. Any ordinary citizen can apply these exact steps today. Step 1 is documenting your exact financial reality. You sit down, calculate your total net worth, and track your monthly cash flow on paper. You have to know your baseline before you can improve it. Step 2 is restructuring your expenses. Most people save whatever happens to be left over at the end of the month. The math only works when you invert that process. You save a fixed percentage first, and you structure your lifestyle around what remains. Step 3 is building your financial fortress. This means funding a dedicated emergency reserve. This chart compares the S&P 500 against active portfolios. 92% of professional managers fail to beat the index over 15 years. Step 4 is consistently buying the index. Over any 20-year period, the S&P has never yielded a negative return, eliminating short-term risk. Step 5 accelerates the entire system. You leverage your existing skills to build an independent income stream alongside your primary job. Every dollar generated here goes directly into your investments. Executing these 5 steps in this precise sequence removes the guesswork from wealth building. It provides a direct mathematical bridge from daily financial anxiety to permanent security. This split comparison shows the exact cost of waiting. Delaying your investment strategy by even a few years results in a massive, permanent loss in your final portfolio value. Compound interest mathematically punishes hesitation. Furthermore, the legislative landscape is shifting. Specific tax laws are scheduled to change in 2026. Optimizing your deductions and retirement contributions right now will save thousands of dollars before these new rules take effect. The Federal Reserve is also actively cutting interest rates. The high-yield savings accounts currently offering near 5% returns are projected to drop to 3% or lower by 2027. The window to lock in these high cash yields is closing. Simultaneously, the barrier to entry in the digital freelance economy has never been lower. But as more regular workers realize this, market saturation increases. Building your secondary income stream today establishes you before the competition arrives. Shrinking interest yields, impending tax shifts, and the strict mathematics of compounding all point to the same conclusion. Taking action before 2027 is a strict financial necessity. Here is your complete execution plan for this week. Day 1 requires 45 minutes. You will physically write down every asset, every liability, your total monthly income, and every expense to establish your exact net worth. On day 2, you open a high-yield savings account. You transfer whatever you can afford into it, even if it is just $50. This immediately establishes your emergency fortress foundation. Day 3 takes 20 minutes. You log into a platform like Fidelity or Vanguard, open a Roth IRA, and purchase shares of the VOO index fund. You set up an automatic monthly transfer so the system runs without your daily input. Day 4 is your debt strategy. You list all outstanding balances from highest to lowest interest rate. You identify any debt charging over 10% and direct all extra cash flow to eliminate it. On day 5, log into your employer's HR portal. Verify that your 401k contribution captures the full employer match. If it does not, increase your contribution to secure that extra capital immediately. Over the weekend, spend day 6 researching one digital side skill, like basic copywriting or social media management, by exploring beginner tutorials. On day 7, cement your progress by writing out a specific 10-year financial target and posting it where you will see it daily. Checking off these 7 daily tasks takes only a few hours of total effort, but completing this sequence automates your wealth-building machine. When 2027 arrives, you will be in one of 2 positions. You can either be sitting with the exact same debt and the exact same financial anxiety, or you can have a fully funded emergency reserve, an active investment portfolio, and a secondary income stream. The calendar moves forward either way. When asked for his ultimate piece of advice, Warren Buffett stated that the best investment you can make is in your own abilities. Knowledge of how money works cannot be eroded by inflation or taxed away. It stays with you forever. Run this through the 5-year test. Ask yourself, 5 years from now, will you be glad you opened that investment account today, or will you wish you had? Every single step in this blueprint passes that test. The shade you sit in 20 years from now depends entirely on the tree you plant today. Start planting right now. Subscribe to Real Money USA for weekly strategies to continue building your financial future.